following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Tomorrow, we are going to have a very special guest on the show. It's my best friend, Byron Tucker. Met him in 1982 when I first started trading in commodities in Chicago Mercantile Exchange. He was running the Goldman Sachs desk. He was Leo Malamad's right-hand man for many years, and he worked with John Corzine, of course, during his time at Goldman Sachs. He's going to tell us some stories. I was speaking with him, like I do every day, over the weekend about some of the things that are happening, and he's going to share some really interesting things. And also, if you have any questions about floor protocol and what's happening with other things like algorithmic trading and HFT trading and stuff, he's really tied into all that stuff. So I think you'll enjoy him as a guest. We're going to start today's show with a T-bond chart. I'm going to walk you through a sequence here, and you can throw vegetables or fruit at this if you like, but it's something I think that looks really, really interesting from a technical basis. Most of you don't remember this, but about 16 years ago, Dr. Andrew Lo came out from MIT. He's the brainchild behind what they call that, the financial engineering and stuff, and he runs a $4 billion hedge fund for cancer research. All the profits from that hedge fund go into cancer research, and he's very successful. He's one of the real bright, he's probably one of the brightest minds in all of Wall Street. But he wrote this book, and he wrote a paper in Business Week. He wrote it on April the 17th, which was Arch Crawford's birthday and also J.P. Morgan's birthday. And the title of it was "This Alchemy Can Yield Pure Gold." And what it was a brief summary of some statistical work that they had done with the stock market over a period of 36 years, and it showed that the patterns that people talk about all the time, the double tops, double bottoms, triple tops, triangles, pennants, head and shoulders patterns, all of these had certain probabilities, and not only were the probabilities repeatable, but these markets actually followed what these patterns were supposed to be, so that it had a predictive quality about it, and it was certainly useful in nature. What he did was he repudiated the work of Burton Malkiel that said that the markets were chaotic, and what Dr. Lo said was, yes, he said the markets are chaotic, but they're not random, and there's a difference between that, and that's what we're looking at when we're looking at pattern recognition. Now we have to make some type of interpretation of what we're looking at here. So we're going to take a look at T-bonds, and the first one was the blank chart. The second thing we're going to do is we're going to, I'm going to do it, you're going to listen. I think that's how this works. Anyway, we're going to look at what happened in T-bonds since the 2008, I guess financial crisis or whatever it was. And if you'll notice the high from 2008 to the high in 2012, and if you take that and move it over, that was 187 weeks. If you multiply that times 2 to get an equal cycle, you'll see that the 374th week came in this past week. So we have perfect time symmetry in the Treasury bond market as we're looking at this today here on the 16th of February. And the next one we're going to look at is the Treasury bond market. Give me 1 second here to put this up. We're going to put a couple of patterns in here a couple of patterns in here to see the same type of thing. But now what we've done is we give these patterns names. And as you can see here, we're looking at a 1, 2, 3 drive to a top pattern. It has perfect symmetry. If you'll notice, the ratio going from 0.2 to 0.3 is exactly 1.618, which is what we really like to see. That's another really nice pattern that we have lining up at that point. So there's another one that makes it look, very, very interesting. So we want to keep that in mind, as we look at that. Now, there's one other one that you need to look at, and that is the, hold on one second here. I want to pull it up here, and you'll be able to see it. This is the final one, which I think is very important for what we're looking at as traders. And in fact, Steve Rhodes could help us out with this, and that is the fact that we're looking at a really nice a butterfly pattern that has occurred here, where we have the ABCD pattern going up. But if you'll notice that we've had these shooting star patterns, you'll notice the one we had back on August the 24th, which was the bottom, where we had the market rallied back up to a 61% in stocks. And look what's happened now. We've had the same thing going on now with the Treasury bonds. We've had this big move. It came almost exactly to the 1.27 of the April high. This puppy's ready to go down. That means higher interest rates, whatever that means. But anyway, that's what it is. And these are just patterns that we're looking at, folks. There's nothing here, etched in stone. You just have to look at, one at a time, and that's really nothing more or nothing less. So something really big happened this past week, and I believe that's the reason, why, these markets turned bullish on Thursday. We had that beautiful 3 drive to a bottom pattern in the Dow Jones Industrial Average, and we had the same thing happening in the NASDAQ. We had the same thing happening in the Hang Seng in Hong Kong, and also in the Nikkei. We pointed out the Nikkei, how it had completed such a long-term pattern with such beautiful symmetry, and the Nikkei's rallied 8% in 3 days. That's a heck of a move. China being closed all last week was supposed to open sharply lower on Monday. And believe it or not, they had the worst data that you could possibly get from China. In fact, I happened to be watching the tube here Sunday night while that data was coming out, and the fellow from Bloomberg was actually startled. He said, "Oh my goodness," he said, "look at this data." He says, "I've never seen data this bad. It was so far off of what they were looking for." And what did the market do? It opened slightly lower and turned around and rallied. Well, markets don't go down on bad news. They only got one way to go, and that's up. So I have to be bullish in this area here in stocks. I might miss this next leg down, but I doubt it. But we'll see. We'll just watch that very, very closally. Okay. Someone mentioned also that Martin Armstrong talks about the non-randomness of the market, and it's there. If you look at it, you can certainly see it. Just last night, the crude oil rallied up to exactly the 786 retracement of the high of 4 days ago, and has dropped $2.50 a barrel. Just truly amazing how some of these numbers work out. Okay, we're going to take a little break. When we come back, we're going to look at the gold and silver markets, because they are also in an area that looks really interesting.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry, powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I've put a chart of from the Financial Times showing you the $6 trillion of debt that is out there that is in negative interest rates. That just seems unfathomable to think about that, but this is part of the problem. This chart looks very similar to the tulip bulb mania of the 1700s. So it's really an amazing chart. So we want to keep an eye on that. Okay, now we're going to talk a little bit about the metals here. But before we do the gold and silver, I wanted to bring out a chart that we don't trade, but it's something that is, very, very important to all of us, and that's the iron ore. And I'm going to bring this chart up so you can take a look at it. Remember, these are just charts. I don't understand the fundamentals behind this stuff. Never have, don't want to know. All I want to know is to see what these charts are doing. But you'll see since, going back last year, you'll notice that we had these three equal rallies in a down market. In the iron ore market. Those are those red arrows that you're looking at. You're seeing equal rallies. The one on the right is very interesting because you can see the really clear ABCD structure that was there at the very end. So that's just the pattern. It's basically a down moving channel where you have lower tops and lower bottoms. That's a definition of a trend line, folks, or a trend. So it doesn't make any difference what that 200-day moving average is doing, in my opinion. If you got lower tops and lower bottoms, you are in a down trend. That's pretty much the bottom line. Okay, let's fish and cut bait here. Here's one that looks really interesting, folks. This is the price of cash gold going back several years. If you'll notice, back in 2014, the market rallied 8 weeks with a $212 rally. And what did we do this last time? We rallied 8 weeks to a $212 rally. I think it was $214 rally, close enough. But if you'll notice that it was a 61% retracement of the high that we made back in 2014, and it was also almost a perfect 78% retracement of the high from 2015. So this is a very, very important chart. Not only that, but we had this really big shooting star pattern again on the weekly chart in gold. So we want to watch that. Folks, gold has dropped since we were looking at it on Friday. We got up to that 1255, 1260 area. It was a fast tick between 1255 and 1262. The market didn't stay there more than 2 minutes. And then it sold off, and it sold off all day Sunday and Monday. And we were down more than $70 an ounce, and that's not usually how a bull market acts. But this could be just the beginning of a bull market, but we'll have to wait and see. But $70, that's a pretty big drop after a run like that. The market was certainly overbought, but that's neither here nor there. That's what's really happened to it. Now, if we take if we take a look at silver, and we're going to look at the same type of thing, only we're going to look at just a daily in silver because it's been, much weaker, but we can still get a pretty good idea of what's happening here. And as you can see, we have this long-term trend line that's been going down for quite some time, and we got up to almost we hit $16 an ounce very, very briefly on Friday. And of course, we've sold off a great deal from that point. But until we get that gold above 1265, I think we're going to be heading down, and we could be heading down sharply. That's the bottom line. Now, last night, the gold had a big sell-off as we were talking about, and we got down to the 1191 level. And since that time, we've had a rally, a little bit of a rally up around the 1216, 1217 level. But if we just look at the harmonic number in gold, which are 18 and 36, if you add 18 to the bottom that we had at 1291, that would give us a potential rally high around here in the gold around 1219, and so far we've been as high as 1217 and change. So we want to watch that 1219 area very, very closely. If we get much above that, then there's a possibility that this sell-off was just a great buying opportunity. Now, 70 points down was basically two harmonic numbers down in the gold, because the harmonic number is 36 times 2 is 72. In fact, I think it was perfect, wasn't it? Let me see. We had a high of 63, yeah, 62, 72. No, it was $2 off from being absolutely perfect. So the first number to watch is the $18 rally back from the bottom, which is also the 382. And if that happens to, continue to go up, would we go up one more, and that would take us up to 1231. So right now you have to be bearish on gold. I don't see any reason, why you have to be bullish at this level. That's the bottom line of what I'm looking at right here. I'm saving the stock market, what do you call it, rhetoric, till we come after the break, because there's a lot of things to show there of why I think this is a pretty significant bottom here in stocks, and we certainly want to pay attention to it, because we have some tremendous rallies coming in a major bear market, and that's pretty much what we have going on at this particular time. So gold and silver looks like they've topped. Treasury bonds have topped. That's non-negotiable. I don't have a chance to do platinum right now, but I'll try to get that by the break if I possibly can, and we'll see if that's going to help out with the analysis for the metals. But frankly, you've got a downtrending move in silver and gold and longer term, and then of course the same thing you're seeing in iron ore. So we'll wait and see. That's what I'm watching from the metal standpoint. So we'll keep an eye out on that. But those symmetrical rallies that we had in gold from 2014, we rallied $212 an ounce, and here again we rallied $214 an ounce in the same time frame, 8 weeks. That means something. There's a really strong symmetrical feeling in what's going on with that particular commodity. Because of that symmetry, you just can't make that stuff up, folks. That's pretty much the bottom line of what we're trying to look at here. Okay, now I've had a question about the E-mini S&P, and might as well get started because I will see what happens. This is what's happened here, folks, overnight. I'll put this in and you'll be able to see we got just a tiny bit higher in the 61% retracement. We got up to, I believe, 1892 last night, and as you can see, there was a bunch of numbers up there, 618 and 786 at previous swings, and now we're backing off a little bit. That gap that's there is the gap from Sunday night, because we were closed Monday, so we don't see the fact that the market was up 100 points on Sunday and another 100 points on Tuesday or on Monday during the holiday. So that puts us in a real bullish mode that we were going up, and now we've backed off. Now, if this market's really bearish, it's going to turn around and just drop like a rock, because it just won't go up. But we'll see. Let's look at this. We'll look at this at the break. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're back, and we have a caller. Jim, are you there?
Yes. How are you today?
I'm good. What can I help you with, young man?
I was wondering, there for a while you were talking about the New York Stock Exchange long-term chart where every 7.5 years we get a huge major downturn. And I was just wondering if you're still bearish about it, or if this is really the bottom and we're turned around.
Well, I'm not sure. I'm not sure whether this is the bottom or not, Jim. But I'm really pretty confident within the old ivory soap 99% pure that we are going to be looking at a major bear market. But this bottom that we have in the New York Stock Exchange Index, along with some of the others that we're watching, not just that, it's the foreign markets, Hang Seng and Japan. It just looks like we're ready for a really good rally. The chart that I posted in here is the past year in the New York Stock Exchange. We had a perfect ABCD pattern there. We also had a double bottom. We had a 1.618 expansion. All those things tells me that we're in the midst of a rally, and we can get tremendous rallies. I don't know, you weren't around at this time, nor was I, but and I don't know if this is a 1929 type market or not, but in 1929, after we had the crash, that was October the 29th of 1929. The market finally bottomed on November the 11th, and then from November the 11th until April the 2nd or 3rd of 1930, the market gained back 60%. Almost 61% retracement of the whole move down from September of 29 into November of 29. So we can get these tremendous rallies. I don't know if that's the case. I'm just a technician, Jim. So all I'm telling you is that it looks like that we're in the midst of a rally right now. That's all I can say. If we take out those lows we made last week, then I'm flat out going to get short again. But right now, it looks like this puppy wants to go higher.
Okay. And there's no way really of knowing how long this rally may last, because I've heard you say before they can last, really short term, or they could go on for a month or two.
That's true. There is no way, but we're going to have some ideas, because usually when we come up with these patterns like this, there's usually some good timing indicators that are there. And for the first spot that we're looking at here, we're looking at the end of the end of February. Another 2 weeks from here to early March. There's a nice cycle that could be coming in, and if we have a spot there at a Fibonacci point, there's a place where we might want to test it again. But this should be a pretty good rally. The other thing that happens, Jim, is maybe this bottom is in, and maybe all we get is what they call the dead cat bounce. This market might rally up and just go up a few days like we have in the past, or a few weeks, and not travel very far. The old high in the NYSE was at 96 and change, and we should take that out easily, and we should get up to close to 1,000, which is about a 8 or 9% rally, from where we are now. So as we get closer, to the end of February, early March, we'll have an idea of what this rally is going to do. But if we come out of here really strong, day after day, look out. This thing could have legs, and it could go a lot higher than some people think.
Yeah. Well, a lot of people are excuse me. A lot of people are worried about the European banks being so bad and contagion to drag our markets down. Do you think that's much of the case?
Well, that's the most widely publicized thing in Europe, is how bad things are. And we've talked about how bad Deutsche Bank is here. I don't know anything about the fundamentals of Deutsche Bank, but the chart is horrible. It was down 5% today at one time in Germany, in the UK, but it came back to be down just about 1%, I believe. But it's headed towards $10 to $5 a share, it looks like to me. But that hasn't any effect on what I'm looking at when I'm looking at the charts. I mean, those are just single charts, and I can't really extrapolate much out of that. And one of the problems that we have in trading, Jim, is we get too much information. We get overload, and that's a bad thing, because you want to try to keep it as simple as possible. And that's what technical analysis does for you. It allows you to just look at the bar charts. It has nothing to do with what's going on. Everything in the background that is going on is affected by that chart, because if there's more buying, prices go up, and if there's more selling, prices go down. And all the patterns do is try to put this together and saying, yeah, this looks like the place where the buyers and sellers are, getting ready to do something. That's really all it is. It's nothing more than a probability. But, if you use it properly, these patterns do work, as Dr. Andrew Lowe has pointed out, but it takes a little time to learn to use it. But it's a very valuable tool.
Yeah. Would you care to look at the SPY ETF and tell me what you think there?
Sure, I will be happy to. I believe I have that one put up here. Just a second. It's one of the things I watch every week, because we have the same type of thing happening in the SPY. It looks like almost exactly like the New York Stock Exchange Index, which is it's the largest. And you can see here with the cash back in December, we had that 135 where we had the lower tops coming in. Each one of them is lower than the other, and they're very symmetrical. Each of them is a 78% rally back from the previous high. And then, of course, starting in January, the market melted down, and now we've made the double bottom. What's interesting about this double bottom, Jim, is on the one that we had here on the 10th of February, we made a lower low in the S&P cash by one tick, which is almost impossible to do. And then, of course, it turned, and then it gapped up, on Friday, and then we're going to be higher again today here. So we'll see what happens. But it is almost identical to the New York Stock Exchange chart. So they're all telling the same story, that this ABCD structure that's here should have some legs. And last time we had a B2C move, it rallied well over 25%. So we don't know. We'll just have to wait to see if the rally is going to happen and how much it's going to give us.
Uh-huh. Well, I really appreciate your information. I really appreciate your show. I like watching it.
Thank you very much, Jim. Where are you calling from?
I'm from calling you from Oldsmar, Florida, but I'm originally from Tennessee. I guess you're the hillbilly in me. I'm from East Tennessee.
No, I never heard. I thought you were from Boston. You sound just like Tom O'Brien.
Oh, my goodness. No, I don't say Shaw for short. But I like this show, too. I'm just kidding,
Okay. Thank you for calling in. I certainly appreciate it.
Well,
okay.
Thank you for taking my call.
It's my pleasure. Okay, since we're talking about the stock market now, what we're going to do is we're going to take a look at the IWM, because this is the one that broke down below some previous support here. And you'll notice here that we had that 1.618 level that hit absolutely perfectly. You'll notice the ABCD pattern here was in vogue, and then we had the big gap down. And then today we're most probably going to gap up and leave an island reversal. That's what it looks like to me. I don't know if that's what's going to happen or not, but this is a smaller index. It's the ETF for the Russell 2000. But this was there were a couple of aberrations in this overall bullish scenario. That happened to be one, and we'll do the next one when we're going back to the next time.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced
experience and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, Swim Lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back, folks, and we're going over some of the stock market indices to tell us whether we've come close to a bottom or not. We'll have to look at it one thing or another. But let's take a look here at the long-term chart of the banking index. This goes back to 2008, and you'll notice we've only had two major ABCD corrections in this. We had one in the summer of 2011, and now we've just completed another one, and it was a very important one because it was a 382 retracement of the whole move going back to 2009, and it was also a 50% retracement of the move that went back into 2011. So this is a very important spot in the banking index, and not only that, but we had sort of a hammer bottom form, which could also be a very important thing to look at. And we've had a lot of negative news in the banking industry these past few months, which we should, because the stock had topped, and this index had topped, and it started to go down. But now that's dissipated a little bit, and we should get a little bit of a rally here. Hey, folks, this is really tough to say that there's a rally coming when someone's as bearish as I am. I mean, long term, I'm really bearish, but this is what I'm seeing. This looks really interesting here because you've got a situation where the markets are incredibly oversold, and the news is really bad now, and now the markets are starting to rally. Look at China. The data coming out of China was so bad, the announcer at Bloomberg was startled, and yet the market rallied. And the Hang Seng has rallied quite a bit off of a perfect 1.618 and 786 retracement. And the one to really watch is the Japanese market, because it's rallied, 8% in 2 days. So that's pretty much it. Okay, someone's asked me a question about where I look to pull back in gold to occur. Basically, what I'm looking at here is we've had a 38% retracement today within $1 of gold. We topped at 1062. We went down to 1191. We rallied back at $19, which or $18, which is pretty much spot on the harmonic number in gold, and that's at the 382 retracement from the high. And as long as we don't take out that 1218 level in the gold, it looks like we're going to be, going back, a little bit lower, and that's pretty much what we're watching here. So that's what it looks like to me. And silver looks bearish. I mean, gold, folks, if gold was really bullish, I really don't believe it would have given up $71 in 2 days. We didn't have that much of a move when it was going down. So that's how I look at it, and the numbers are certainly there in the gold market. I mean, we hit those numbers spot on. We have the shooting star, pattern in the candles for the gold and the silver. So to me, look for a place to sell it. Don't look for a place to buy it. If you want a really good place to buy it, what you'd be looking for, if the first leg down, Danny, was 70. And then we rallied up to 382, then all you have to do is to the high of that leg, if that's here in gold right now, is at 1218. And if you subtract, 70 for that, that would take you down to down to around 1138. And that's where the old breakout was. So if the next leg I would be looking at in gold would be down around 1130 to 1140, because that's where the big trend line break was, to the upside, because we had so many numbers coming in there, and it blasted through those. So that should act as support on the way back. That would be down, roughly, 77, be down 100 and be down $120 from the high. But when the markets are jumping around as much as they are, that you could get that very, very easily. So that's what we're watching in the gold, and then also in the silver. Okay, someone asked the question about the S&P futures for today. Okay, last night the S&P, the 61% retracement was at 1890. That was the one that we posted in the room here early this morning. Then after that, the market has sold off. Then it had a little bit of a rally up to around the 1883 or 84 level. That sets up some very strong support between 1873 and 1868. And 1868 is the high end of the range of where we closed on Friday. That would be down there filling the gap, which we could certainly do. However, let me mention to you that there's a possibility that I'm totally wrong, that there's a rally coming. I don't think that I'm wrong, but there's always that possibility. So if this market, starts to give up the ghost really quick, and you're starting to see it drop faster and faster, chances are that I'm wrong. But if it's really quiet and struggles to go down, then most probably this is just a reaction to a overbought situation over the last 3 days, and that's all that's fixing. But other than that, I don't see that. Right now, it looks like we've got a chance for a pretty substantial rally here in this. But I could be totally wrong, and you got to be able to admit it, and that's literally the way that it goes. But the number in that S&P is around 1872 to 1869. That would be what I would be watching. The bond market is telling us that stocks want to go higher. I mean, the bonds look like they can't even, they look so bearish, it's absolutely scary, is what that looks like. Now, one thing I would caution you is about the crude oil. I mean, the financial press is telling you that this rally that we're having is related to crude oil. Folks, I don't believe that. I believe it was related to that flight to quality in Treasury bonds, because the Treasury bond market and the Treasury note market are far, far bigger than the oil market. And this is where the real money was, when they have the risk on, when everybody wants to buy stocks, and when the risk is off, everybody wants to buy bonds. And that's what happened. And we had this major major reversal up here that we tried to show you at the beginning of the show here when we had the 3 drive to a top pattern that was perfectly symmetrical. So that's what I think it is. I don't think it has much to do with crude oil. Now, crude oil, we went up to a 78% retracement of the high we made back on February, what day was that? February the 4th. And now all we're doing is we're making another correction, and the 61% retracement on the crude oil comes in at about 80 cents from where we are now, right around that 30.60 level in April crude. And if that holds, then you've got another chance, for the market to rally. But this has been in a downtrend for forever. And it certainly has bearish fundamentals if you follow fundamentals. I mean, they tell you about them all day long on CNBC and Bloomberg. So anyway, I'm just looking at the charts. That's all I'm looking at. Oh, by the way, I did want to mention again, we are going to have Byron Tucker. He's going to be our guest tomorrow. He was the gentleman who worked with Leo Melamed to help build the Chicago Mercantile Exchange stuff, and from the University of Chicago and Amherst University. And he ran the Goldman Sachs desk in Chicago. That's when I first met him. He came in one day wearing a beautiful Brooks Brothers suit, and he had galoshes on because the snow was so high. And I got a big kick at that. He was late getting in, and so he still had his galoshes on, and I started laughing about it. And he sent his runner over to the pit to ask why I was laughing at him, and we became friends after that. 877-927-6648.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I'm going to post a chart here of the Dow Jones Transportations, showing you the what's happened over the past several weeks. And as you can see, it didn't make a double bottom when the New York Stock Exchange and the S&P were making double bottoms. It was making higher bottoms after it completed that big ABCD pattern down there, which was, one of the factors that was telling us we had a lot of these patterns completing. So that's what we're watching right here. But we still have a situation where this thing, longer term, it's bearish, but shorter term, this looks really friendly, folks. I can't say enough. Now, I know we're selling off in the futures to get down to where we were maybe on Friday, but I think we're going to hold the 1869 level. If we don't hold that level, then this thing could get a whole lot worse, and that could be a situation that could happen because these markets longer term are just very, very bearish from the the long-term perspective of what we've been watching for such a long time. Now, there's been a lot of talk. One of the questions that we have is there's been a lot of talk about the Japanese yen and what they've been doing in Japan, and we had the same type of a pattern that supports the yen, and that is right at the level where we hit around that 111. That was the 382 retracement within about 60 pips, I believe, and we've had a 300-point rally, and that rally stopped, by the way, exactly at a 38% retracement of the high we made on February 1st. So that was another reason why the market started to turn a little bit yesterday on some of these markets, because the yen really moves along the yen dollar spread. The cross rate moves very closely to what is happening in our stock market. But the bond market is the key. Look at the bond market. This bond market has been hit, and it's got the skull and crossbones on it, folks. If it turns really strong from here, then I will gladly get on one of Tom O'Brien's fleet of yachts and go from there. So live every day in an attitude of gratitude, and may God bless.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.